Hi everyone, welcome back to Lab4crypto. In the past few months, I have been vocal about the incredible potential of the upcoming 2024-25 period, which I believe it will create the next wave of crypto millionaires. With factors like quantitative easing, the US elections, and the institutional adoption of Bitcoin and Ethereum, we are on the brink of massive influx of capital into the crypto market. I am projecting that the total crypto market will reach a staggering 10 trillion valuation by 2025. You can find many videos I have made in this topic over the past few months, so be sure to check those out for more details. As the crypto industry prepares for this potentially once-in-a-lifetime opportunity, I have received numerous questions from you guys about how to identify the right time to exit the market when it reaches these highs. As usually people believe that it will keep going up, they never exit the market, and they are keep seeing their basically portfolio valuation going down. In today's video, I will share my top models for identifying Bitcoin cycle top. Of course, if you use a model that is not in the list and it had served you well in the past, keep using it. These models are crucial for making informed decisions, and they are what I have used in the past and it served me personally well. So let's dive into these models, and I will try to help you understand the importance of exiting the market at the right time, as do not forget the crypto market is very volatile and you can have 80 to 90% drawdown from all-time high when we enter a bear market. So you need to know when to exit. Let's dive in. Because I didn't want this video to be too long, I decided to narrow my list just to the top 4 models that I think are useful for you to monitor when we enter the full steam bull run in 2025. Of course, for people that have more experience in the crypto market, they may be using a different model to identify the cycle tops, and that is fine if that works for you. Or you can compare them with the ones that I'm going to show you now and see if any of the new ones that I'm going to show you now are giving you a better value compared to the ones that you are using. Because even a slightly better model can give you huge optimization on your portfolio performance. And the reason is simple. The crypto market is volatile. And I think this volatility actually is a feature, not a bug. When you have an asset which is volatile, you can earn a lot of money if you manage to time as best as you can the cycle top. Of course, no one can identify to the date, although some models manage to do it. But in general, you have models that are signaling that we are approaching the cycle top, and therefore you need to build your strategy. Because, for example, Bitcoin usually has a drawdown from its all-time high between 80 to 90%, which is a lot. Imagine, for simplicity reasons, Bitcoin is going to reach 100K by the end of this cycle, which I think is going to be much more. But imagine it's 100K. That means your Bitcoin, if you don't time correctly when it's a good time for you to exit the market, and you are keep thinking that it's going to go up and you have all the indicators signaling that that is not true, you are going to keep seeing your basically portfolio performance, your portfolio value to keep dropping, because you're going to think that it's going to go to higher valuations. And that is what it happened actually in 2021. People were expecting Bitcoin to reach 100K in the last cycle, but it only went to the 69K region. And if you didn't have indicators to signal that the risk was high and it's a good time for you to exit the market, you are fortunately watching the value of your portfolio going down, and eventually Bitcoin reached prices which was close to 15K. And just to give you a perspective, if the cycle top is 100K, as I said again from simplicity reasons, because I don't want to give the false idea that I believe is going to be 100K, it can reach 20K by the end of the bear market. And that is a huge drawdown from all-time high and from your portfolio performance. That is why it's crucial for you to have these top indicators to help you identify when is a good time to exit the market, because in the end, nothing is going up forever. And I don't mean in a macro scale, because Bitcoin is going up all the time, but it had this 90% drawdown from all-time high as each cycle was passing through. Moving forward, the next is going to be the free float market value to realized value model, which again, it served me really well in the past. And this model, which always do not forget that I have a dedicated video for each model that I'm going to show you, which you can check in our YouTube channel and have a deeper dive in each model. But in short, this model is going to be the deviation, the free float market cap divided by the realized cap. And by free float, what we are doing in short, we are subtracting the coins that are not active for the last 5 years. Because the coins, for example, that Satoshi mined in 2010, the probability of them using and enter the market is really low because are dormant for the past 14 years. Therefore, when we do our calculations to identify the top, we are removing the coins that are not active for the last 5 years, because we are estimating that these coins are not going to move, because are maybe investors that have a long-term view and are not acquiring Bitcoin just for the short term or for a swing trade or whatever. Next is the net unrealized profit and loss. Again, this model is the market cap of Bitcoin, in this case, of the asset you are looking, minus the realized cap, and then we divide by the market cap. And we will see that there is a value that Bitcoin, when it reaches this close to this value, which roughly is above 60 to 63, is signal cycle tops. But as I said, we are going to go more deep in each model in a bit. I'm just showing you the names. And the next one is the price power law model. And by using this model, which it helps us project also the future value of Bitcoin if we mouse over, but by hiding the standard deviations, let me hide them to help you see it closely. By just taking the deviation between the fit of the price power law model from the price of Bitcoin, we see this graph. And this graph on the right side, you will see, is the deviation of the price of Bitcoin from the fit of the line. So from the equation that describes the increase of the price of Bitcoin as a function of time, which in short is this one. But the main idea is that by just checking the deviation, you will see that Bitcoin, usually when the deviation from the feed is above 73, we are starting to think, and it's good for us to starting to believe that Bitcoin is reaching its cycle top. Therefore, it's good for us to build our exit strategy, even if that is a DCA strategy or a linear one or a dynamic one, because personally I prefer a dynamic one. And when I use the risk metric as we go to higher risk values, so when we are between 75 to 100% risk, I'm usually offloading most of my capital, most of my Bitcoin at these ranges. And as we just go above 50 to 60, I'm slowly offloading some of my Bitcoin. And on the lower risk, as I said before, I accumulate, but because this video is only focused for the top signals, you can always check the video that I have below. And also these videos are available into our YouTube channel, which you can check and see how it can help you also accumulate Bitcoin in really good valuations and exit as well. Let's have a look first on the price vs risk, and then I'm going to briefly show you each model, and I'm going to show you which values historically signaled that it was a good time for you to build your exit strategy and prepare for this huge drawdown that usually Bitcoin and other cryptocurrencies have. For example, if you go to Ethereum, it's the same thing. They have these huge drawdowns. that, as I said before, is a feature and not a bug in the crypto industry. Let's go to the price vs risk. Immediately, by just seeing the graph, you will see that in each cycle, when Bitcoin was at valuations between 80 to 100%, was a good time for you to exit the market. And that actually was in every cycle, even in the double peak which we had for Bitcoin in 2021, which was the cycle which we had a peak in February 2021 and November. And also you will see that this model did an amazing job recently when we had Bitcoin cycle top in March, which the price of Bitcoin was 73K and the risk was at 81.58. So it was signaling that Bitcoin was going to go to lower values, and that is true because Bitcoin went to values of 58.1K. Therefore, I guess it's really good indicator to use as it signaled that the risk was at almost 82% in March, and then and May 2024, when the price of Bitcoin was 58, that was dropped to 51. Because this model, it's dynamic, it's really dynamic. And what it means, because we use on-chain and off-chain data daily, you will see that's very sensitive to acquiring these cycle tops and bottoms. But let's stick to the tops because it does not watch the normal metrics that the market is watching. For example, the price, the volume, the volatility, and all the standard metrics that are used in the traditional finance. But we also encompass the on-chain data, which we think are really important to have an indicator which combines both. And Bitcoin did, and RiskMetrics did an amazing job in each cycle. And also what it did as well, it managed to get the FTX crash 3 months before it happened. Because we use also the on-chain data and we use the abnormalities that we see on the on-chain metrics, we managed to get the FTX crash when, for example, FTX price was at $29. A day later, which was just 30.4, the risk jumped to 72%, and it was signaling that it was a good time for you to exit the market because something was off. And unfortunately, we saw the FTX crash and went to values of 0.24 cents, and therefore having a sensitive metric which identifies the on-chain and off-chain data daily, because this metric updates every 24 hours, it's very useful to help you reduce your risk and manage it and be prepared in case we see something very off in the market. Because your risk is not only on the cycle top, but when something it's really abnormal in the on-chain data, and it's good for you to just monitor if you don't want to exit the market, just to be aware that it's a good for you to dig a bit more in the chain that you are more interested in and prepare your strategy in case you don't like what you are seeing. Let's move to the next model. The next model is the free float market value to realized value model. And by just seeing the historical data of this model, simply when Bitcoin price goes on a value above 2, between 2 and 3, was a really good time for you to start preparing your exit strategy. Therefore, when we calculate every day the FFMVRV, you will see that this indicator recently, when we had the peak of Bitcoin, which was at close to 73K, it was close to 2. It didn't manage to get this small local top for Bitcoin. It was really close actually, because in the last cycle, when we check the November top of Bitcoin at 67K, the FFMVRV was at 2.19. And on the previous one was at 2.879 and 3. So that is why when you are seeing this model, it's an easy method for you to start saying that things are heating up and it's a good time for me to start building my exit DCA strategy, for example. It doesn't mean that when it crosses 2, immediately it's the cycle top. It means that you need to sit down and prepare the strategy and start exiting slowly as we approach higher values. For example, you'll say, okay, when the value here was 2 and Bitcoin price was at 82.8 from the low value of 5K that it was, you are starting to exit slowly, and until you reach a value of 3, you offload the majority of your capital. Or you can immediately say that when it crosses 2.5, I'm going to exit one time off, because you cannot always assume that it will reach the value of 3, because in the second peak that we had in November, the value that it reached was only 2.25, for example. Therefore, you cannot be 100% sure that after it crosses 2, that Bitcoin will drop. But for example, when I was got the signal that Bitcoin risk was at 80 to 83%, I went and checked that also the free float MVRV was really close to, did I close it? Sorry. When I checked the free float MVRV, the value was at 1.8, 1.9 basically. That was close to the threshold, and therefore it gave me a greater conviction when I exited the market. But of course, I did it with a higher percentage, and you can find the exact amount in our premium Telegram, which I show exactly what I'm doing. But in short, I like to combine these models to give me a conviction about my decision making. And the next model that I have used was the NUPL. And now, what is this NUPL? To calculate the net unrealized profit and loss, we are using this equation. Is the market cap of Bitcoin, in this case, minus its realized cap divided by the market cap. The market cap of an asset is just its price multiplied by its supply. So if Bitcoin available supply is 19 million and Bitcoin price is 30K, we just multiply 19 million by 30K. Now, what is the realized cap? The realized cap is something that we can derive from on-chain metrics. And because the crypto market is volatile, especially just in a couple of days, Bitcoin price can go from 10K to 30K, for example, we are using the price of Bitcoin when it was last moved to calculate the realized cap. So what is the realized cap? Imagine that I came to your house to do a paint work, and I told you that I want 10K, $10,000 to paint your house. You told me that, okay, I agree with this price, but I'm going to pay you with Bitcoin. And one Bitcoin at the time was worth 10K. So we both agreed that Bitcoin price, Bitcoin worth was 10K. Therefore, you transferred to me, you paid me that one Bitcoin, and that Bitcoin is sitting into my wallet. I didn't move it. I didn't decide to move it around. And although Bitcoin price is 20K because it moved rapidly because of volatility, if I don't move this Bitcoin to an exchange or manage to exchange it or trade it with someone else at a price of 20K, that means the price of my BTC is still worth 10K. So I hope I didn't confuse you, but in short, the realized cap is calculated based on on-chain metrics, based on the price that two people, because we are assuming that when you transfer one BTC to someone else, you agree that the price of Bitcoin at the time is the correct one. Therefore, just to immediately tell you the answer on how to use this NUPL, you will see if you go to historical data, you will have until 2014 now on the chart. But when Bitcoin price goes above 0.16, you will see also in the last peak that we had in 2021, When Bitcoin price, when the NUPL goes between 63 to 65 and 66 and above that, we are starting to have the cycle top for Bitcoin. On the first top, the NUPL was between, it started from 0.68 and went all the way up to 0.75. On the second peak was at 0.66. If we go back to 2017, the price was at 75.79 and so on. Therefore, you need to start building your exit strategy when we are seeing NUPL values above 0.65 to 0.75. And that served us well also in the last peak of Bitcoin, which the value was 0.64. And therefore, as I said again, when I decided to exit with 40% of my Bitcoin when Bitcoin was at 73K, it helped me strengthen my conviction when I had the models that I showed you before signaling the same thing. A new model, which I think it's not that good on local tops for Bitcoin, but it's good for cycle tops, because here, this top, I think personally that it was a local top for Bitcoin. And we're going to see Bitcoin reaching values above 150K at the top of this cycle. But that, as I said again, it's more sensitive. This model, the price power law, did a really good job in identifying the cycle tops for Bitcoin. So the maximum value that Bitcoin reaches at in each cycle, and easily we can check it from this graph, which is the deviation from the power law. And when Bitcoin deviation from its fair value feed, it's above 73, 74, it was a really good time for you to exit the market. And I have these color-coded dots, which you will see between orange and red was a really good time for you to exit. And in short, another easy way to see that, if we use the two standard deviation from the fair value, so from the red line, when Bitcoin goes above this green line, and you will see that in each cycle, Bitcoin has a reduced upside, of course, because the market cap is increasing, but also its deviation from the two standard deviation comes closer and closer to the green line. On 2013, the deviation of a blue line from the green line was greater. Then in 2017 was reduced. In 2021 was reduced even further. So you can assume that when Bitcoin price, the blue line, goes and just touches the two standard deviation, which is the green line, it's a good time for you to starting building your exit strategy. I hope that I explained the top 4 indicators that I am using, and always it's a good method, it's a good strategy to always combine models to have the best results. For example, for me, I also want to know where the total crypto market cap stands as a whole, not just an asset that I'm watching, which is, for example, Bitcoin. And the total crypto market capitalization power law again did a really good job identifying the peaks when we go and we use the same method, which is the deviation from the feed. So again, the deviation from the blue line from the red line. You can use the NVRV Z-score. But again, there are so many models that you can use, but these 4 will do the trick in my opinion. And hopefully you will be able to secure your gains and do not just seeing your capital going down with just expecting that it's going to be recovered, because it's the biggest trap, seeing your portfolio value going down, assuming that Bitcoin will recover or whatever asset will recover, and do not have measures to safeguard your gains. I hope you like the video. Please give us a thumbs up and leave a comment, as that helps us grow. And until next time, bye-bye.